Namaste, Namaskara, Vanakkam everyone. Welcome to second part of Income Tax Marathon series for CA Inter and CMA Inter for May or June 2025 examinations. Guys, if you have missed my part 1 of Income Tax Marathon series, I will leave the link of that video in this video's description. Now, whatever book you are looking at the screen, this book also you can download. For that also I will be leaving a link in the description. Now what I'll be covering in this video, in this part 2, three concepts or three chapters are covered, boss. One is clubbing of income, the other is set off and carry forward of losses, and return filing and self assessment. All the other chapters have already been covered in part 1 video, boss. So please do watch that as well. Thank you so much. The next topic of our discussion is clubbing of income. Boss, everyone hates to pay tax. No one happily pays tax to the government. So, whatever income is earned by the taxpayer is generally the taxpayer will try to pay as much as a less tax. He will not want to pay more tax. So, what he will do? He will do a lot of tax planning so that he can save his tax and he can pay very less taxes. But the government will always want the taxpayer to pay more taxes. In this chapter, we will see all those kind of tax planning which a taxpayer does to reduce his taxes, and alternatively also we will see how the government keep a check on these kind of malpractices so that government can get more revenue in the form of taxes. First example, let me take one example, boss. It is a very beautiful example. Let's say, for example, Virat Kohli and Anushka Sharma. We know that these two are what? These two are married, no? Couple, yes or no? So you can say Anushka Sharma is a spouse of Virat Kohli. Let's imagine Virat Kohli is a salaried employee. Virat Kohli is a salaried employee and his salary, for example, is 10 lakh rupees per annum. So Virat Kohli has a salary income which is 10 lakhs per annum, for example. Okay, and also he owns a house property. He owns a house property for which rental income is 3 lakh rupees. Rental income is 3 lakh rupees. So if you look at this, total income of Virat Kohli will become 13 lakhs. 13 lakhs. Yes or no? Yes or no? Now, in the case of individual, let's imagine this person is paying tax under optional tax regime. Optional tax regime. In that case, what is the slab rate? Do you know what is the slab rate? 0 to 2.5 lakhs, it is 0. 2.5 lakhs to 5 lakhs, it is 5%. 5 to 10 lakhs, it is 20%. And beyond 10 lakhs, it is 30%. Yes or no in the case of individual? Now, just imagine what kind of a tax planning Virat Kohli wants to do. 10 lakhs, up to 10 lakhs salary, so he cannot do anything because that is salary income. He cannot change that. But one change he can do in his total income. You know what it is? This 3 lakhs of rental income, if he plans to tax it in hands of Anushka. Let's imagine Anushka is at a housewife only. She does not have any kind of income. So if Virat Kohli gifts the house property to Anushka, then rental income will be credited in Anushka's bank account, and here from no income, Anushka will get 3 lakhs of income. Then you will be thinking, sir, in Anushka's hand it will get taxed. No, no, boss, because in the case of an individual, there is a concept of a rebate to 5 lakhs. If you are under optional tax regime up to 5 lakhs, you don't need to pay any taxes. Or even if you look at this 3 lakhs, 0 to 2.5 lakhs, 0, 2.5 to 5 lakhs, whatever, 0, 2.5 to 3 lakhs, that 50,000, 5% is how much? 2,500 something. That will get as a rebate. No, nothing, she'll pay tax. Means on this 3 lakh rupees, if it is received by Anushka, then tax on this 3 lakh will become 0. Whereas if that rental income is received by Mr. Virat Kohli only, in that case, 10 lakhs plus 3 lakhs, the income will become 13 lakhs. And on this 3 lakh, which is beyond the 10 lakhs, the tax rate will become 30%, no boss. So on 3 lakhs, 30% is how much? I think it will be, 1 second, 3 lakhs into 30%, 90,000, boss. 90,000 Virat Kohli will pay tax. Why 90,000 he will pay tax? Already up to 10 lakhs of salary, he will be paying tax at the rate of 20%. And extra 3 lakhs, whatever he will get, that will be taxed under a 30% slab. No, because the income is exceeding 10 lakhs already. So by doing one transaction, Virat Kohli can save 90,000. What is the transaction? He can gift the house property as it is to Anushka. Now you will be thinking, sir, gift will be taxed. No, no, boss. Remember section 47, transactions not regarded as transfer under capital gains head we have discussed. If you gift a property, gift is not regarded as transfer. So very simple, Virat Kohli rather keeping a house property in his own hand and rather taking a rental income on his in his own account, he will do what? Simply he will take the property and gift it to his wife Anushka, and Anushka can happily claim that income as her income, and can claim basic exemption limit or a rebate, and no need to pay any tax on that rental income. Very simple. People used to do this, and that is why government caught all these kind of transactions and changed the law so that even if Virat Kohli gifts the property to spouse who is Anushka Sharma, then the rental income, whatever 3 lakhs fetched by that property, will be taxed in the hands of Virat Kohli only. Now, what Virat Kohli thought, no, okay, if I transfer the property without consideration to my wife, then problem is arising. Let me do one thing. Without transferring the property, I will transfer the income only. How? They see, Virat Kohli went to one that agreement fellow, notary people, and he written he prepared one agreement. In that agreement, he wrote, I am not transferring the property, I am transferring the right to receive the rent to my wife. In my property, I do not have right to take that rental income. I am transferring the right to receive the rental income to my wife Anushka Sharma. He wrote one agreement, he prepared and got it notarized, and like that he wanted to transfer the rental income without transferring the without transferring the house property itself. Even those kind of transactions are regarded as clubbing transactions, and that rental income will also be taxed in the hands of Virat Kohli. Are you getting this? So these kind of transactions we are going to look at. So what we are going to discuss is an assessee is usually taxed on his own income, but in some cases he may taxed on other person's income. So in our case, we have seen Virat Kohli's income actually, but he transferred the income to Anushka Sharma. Though it is Anushka Sharma's income, it will be taxed in the hands of Virat Kohli only. Income transferred to family members will be taxed in the hands of the transferor. Who is the transferor? Virat Kohli is a transferor. Transfer of income without the transfer of asset. In the example which we have seen, if any person transfer the income with transferring the asset, then such income is to be included in the hands of transferor. Now understand, there are two kinds of transfer. Let's take one more example. Now Virat Kohli understood that, boss, if I transfer asset without consideration or with inadequate consideration to my spouse, then clubbing provisions are getting attracted. If I don't transfer the asset but only transfer the income, still clubbing provisions are getting attracted. Let me think of some other route, and that route is called as a trust route. What is a trust route? See, Virat Kohli simply will create a trust. It is an entity, trust entity, and transfer the house property to trust. Rather transferring the house property to directly to Anushka, because if directly it is gifted to Anushka, shipping provisions are getting attracted. So what Virat Kohli thought, let me create one trust. I will transfer this. I will donate my house property to the trust. Trust beneficiary, trust owner is everything is Virat Kohli only. Who created the trust? Virat Kohli. In that trust, Virat Kohli will donate or transfer the house property, and in the trust deed it will be written that the beneficiary of the rent should be Anushka Sharma. So rather directly transferring the rental income to Anushka Sharma, indirectly by way of a trust it is getting transferred. Now remember, in the hand of trust, whatever income gets generated, that gets exempted. Yes or no? In the case of a trust, so beneficiary is made as Anushka Sharma, and in the hands of a trust it will not get taxed. So happily that rental income is escaping taxation. This kind of a transaction is the by way of a trust. Now, in the case of transfer to trust, there are two kinds of transfer, boss. One is called as revocable transfer. The other is called irrevocable transfer. Irrevocable transfer. Revocable transfer means the transferor has the right any time to take back that property from the transferee. Irrevocable means the transferor, once he has transferred the property to the transferee, he can never in lifetime he can get back that property ownership. Are you getting that? So in revocable, you have the right to again take back the property from the receiver, but in the case of irrevocable transfer, you can never get back the ownership in that asset. Now let's say for example, let's look at this example which I have given here. In the case of transfer of income without a transfer of asset, if Mr. Vijay gives to his wife Mrs. Basanti the right to receive rent from his property without transferring the property, the rental income will be taxed in Mr. Vijay's total income. Income arising from revocable transfer of asset. See, boss, if it is a revocable transfer, means you have the right to take back the property. In that case, clubbing provision will apply. If it is an irrevocable transfer, means you once you transfer the property in lifetime, you can never get back that property in your hands. In that case, clubbing provisions will not apply. So, if it is a revocable, clubbing will apply. All income arising to any income by way of revocable transfer of asset is to be included in the total income of transferor. Who is transferor here? Mr. Virat Kohli. As per section 60, the transfer is revocable if it allows the transferor to regain the control over the assets. The clubbing provision applies even if only part of the income from the transfer asset benefits the transferor. Now, if the transfer is revocable, all income from the asset is included in transferor's income. Are you getting it? So the income will be taxed in the hands of Virat Kohli only, even if he transfers the asset to a trust, because it is a revocable transfer. Exception. There is only one exception, boss. If in the transfer of in the transaction of transfer of asset to trust, if though it is a revocable transfer, but you do not have the right to take back the control of the asset during the lifetime of the transferee, only in that case clubbing will not apply. I repeat, let's say for example, in the trust deed it is written that the transferor of the asset does not have right in the asset until the transferee or the beneficiary dies. Until the beneficiary dies, that kind of a revocable transfer, if it is, means once the beneficiary will die, once the beneficiary dies, this transferor can take back the property. But until the beneficiary of this asset, if the beneficiary of the asset is alive, until then, if the transferor does not have any right to take back the property, in that case clubbing provisions will not apply. So clubbing will not apply in below case even if it is revocable transfer. If the transfer is by way of a trust or any other form which is not revocable during the lifetime of the beneficiary or a transferee, but can be revoked after the death of a beneficiary or transferee, in this case clubbing provisions will not apply. Example: Mr. Rajesh transfers his house property to a trust for Mr. Ramesh's benefit until his death. The income from the property is taxed in the trust's hand during Mr. Ramesh's lifetime. After his death, since the transfer becomes revocable, the income is included in Mr. Rajesh's income. Is it clear? Next, clubbing of income arising to spouse. Let's say, for example, Virat Kohli is already working with one organization, boss. Please understand this. Virat Kohli is working in an organization where he draws a salary of, let's say, for example, 10 lakh rupees. He is drawing a salary. Okay. 10 lakhs rupees he is drawing a salary. And also, let's say, for example, in the same organization, Virat Kohli has more than 20% of a shareholding also. More than 20% of a shareholding he is holding already. So means Virat Kohli has a substantial interest in this organization. Substantial interest in this organization, and Virat Kohli is drawing a salary of 10 lakhs, for example. Now, 10 lakhs, if he is drawing a salary, then we can easily say that from 2.5 to 5 lakhs, the tax will be at the rate of 5%, and 5 to 10 lakhs of income, the tax is at the rate of 20% out of this 10 lakhs, yes or no? But he wants to escape tax. What he will do? He will tell the organization, boss, do one thing, pay me only 5 lakhs of a salary. Rest 5 lakhs you pay to my spouse. We will add Anushka Sharma as an employee in the organization, and you split my 10 lakhs of salary, like 5 lakhs in my hands and 5 lakhs in my spouse's hand. Why it will be, how it will be beneficial for Virat Kohli? Boss, if it is a 10 lakhs, then 1 lakh 12,500 tax is levied on Virat Kohli's salary. But if the salary is getting split in 5 lakhs in the hands of Virat Kohli and 5 lakhs in the hand of Anushka, then both individually they are getting only total income of 5 lakhs. Both can take a rebate under section 87A. Then zero tax on this total 10 lakhs of salary. No, then 1 lakh 12,500 of tax is saved. No, totally. Are you getting this? So how do they want to save the taxes? So if Virat Kohli plans to do this, in that case, clubbing provisions will apply. Let's have a look at this provision. Income by way of remuneration from a concern in which the individual has substantial interest. So Virat Kohli has substantial interest in an organization, and spouse is getting salary from such organization. In that case, clubbing provision will apply. But let's say, for example, Anushka Sharma is getting salary because of her own talent. She is actually, let's say, for example, she is employed as a finance head in that organization. If Anushka Sharma is really a chartered accountant and really genuinely she is working in the organization in which Virat Kohli has substantial interest, in that case, clubbing provision will not apply. Any income such as salary, commission, fees received by his or her spouse from a business where the individual has substantial interest has to be included. What is the substantial interest in a concern? If the concern is a company, in that case, if 20% or more of the voting power is with a person, it is called as a substantial interest. In all other cases, minimum 20% or more of the profit share, if any person is having, that will be called as a substantial interest in the organization. However, clubbing does not apply if the spouse earns income on her or his own professional skills. Now, the next one, income arising to spouse from asset transferred without adequate consideration. The first example I took, where Virat Kohli transfers his asset to Anushka Sharma without any consideration or for inadequate consideration. In that case, clubbing provisions will apply. If one spouse transfers to another without adequate consideration, except in cases of separation, if Virat Kohli and Anushka Sharma plans to get separated, in that case, if asset is transferred to Anushka Sharma, then in that case the clubbing provision will not apply. Any income from the asset will be included in transferor spouse's total income. If an individual transfers a house property without adequate consideration, the transferor is still the owner, considered the owner, and the property's income is taxed in the hands of transferor's hand. Income arising on transferred assets alone have to be clubbed. Income earned from reinvesting the income cannot be clubbed. Let's say, for example, out of the rental income, whatever Anushka got, she has invested that income in some shares and got some dividend income. That dividend income cannot be clubbed in Virat Kohli's hand. Only that rental income which she fetched from the asset can only be clubbed. The next point is, if assets are transferred to spouse or invested in business. Let's say, for example, Virat Kohli gifts some money to Anushka, and that money she invests in some business. If any profit is earned out of that business, or even if interest on that capital contribution is received by Anushka, even those will be clubbed. If asset is transferred to spouse or invested in business, the income from such investment, including interest from capital contribution, will be included in transferor's income. How much of the PGBP income will be clubbed, sir? Income from business, if you multiply with the amount gifted by assessee, means amount gifted by Virat Kohli divided by opening capital of business on first day of previous year. If you do this, what is that amount which has to be clubbed in Virat Kohli's hand? You can know that much will be taxed in the hands of Virat Kohli. Transfer of assets for the benefit of spouse. If you transfer the asset for the benefit of spouse to someone, and if any benefit is received by Anushka, still that will be clubbed. So the next thing is clubbing of income arising to son's wife. If a mother-in-law or father-in-law transfers an asset without adequate consideration, or without any consideration to daughter-in-law, in that case, if any income is generated out of that asset, in that case, that will be clubbed in the hands of a mother-in-law or a father-in-law. Next thing is clubbing of minor's income. If the child of a parent earns some income out of his or her own talent, in that case clubbing will not happen. Let's say for example, the child participates in some national TV program, some competition, and earns some money, prize money. That kind of a money will not be clubbed in the parents hand, because it is earned by way of his or her own talent. But otherwise, let's say for example, if the parents transfers any property to the children without any consideration, or even if without a inadequate consideration, in that case, if any income is generated out of the asset, that income will be clubbed in the hands of parent. Sir, in which parent the income has to be clubbed? That parent whose income is higher, in that parent's hand the income will be clubbed. If the parents are divorced, the parent who takes care or maintains the child, in that parent's hand the income will be clubbed. But keep in mind one thing: whenever you are clubbing a minor child's income in the hands of parents, exemption to the parent up to 1,500 will be provided. Let's say for example, if the child is a disabled person, under section 80 you see disability, we had discussed in the chapter of deductions. So if a child is a 80 disabled children, and if he receives any compensation from the government, that income cannot be clubbed in a parent's hand. So let's look at these points. All income of a minor is to be included in the income of his or her parents. Manual work, if out of manual work or skill or talent, that should not be included. Parents income whose total income is higher, in that parents hands it will be clubbed. Club if once a minor's income is clubbed with one parent, it won't be included in other parents in future unless the AO wants to change. So if you start clubbing in the income in one parent's hand, then you should keep continuing in that same parent's hand only. If parents are separated, then whoever maintains the child, in that person's hand it will be clubbed. If a minor child has a disability of 80 then it will not be clubbed. Clubbing provisions are attracted even in respect of a minor married daughter also. Exemption, as I told you already, 1,500 will be given. If a house property is transferred, then in that case clubbing will happen. Now, cross transfer. What is this, sir? See, if Virat Kohli transfers a asset to Anushka Sharma without consideration, then clubbing is getting attracted. Let's say, for example, Virat Kohli has a own brother, and that brother is also married to his spouse. So there are four parties: Virat Kohli, Anushka Sharma, wife and husband, Virat Kohli's own brother, and the brother's wife. So these are the four parties. Now, if Virat Kohli transfers asset to Anushka Sharma, clipping is happening. But if Virat Kohli transfers asset to brother's wife, clubbing will not happen. No. So what Virat Kohli will do? They will get into one agreement. See, boss, he will tell to his brother. Virat Kohli will tell to his brother. See, if I directly transfer her to Anushka Sharma, clubbing provisions are getting attracted. Income is getting taxed in my hand. We will do one thing. You transfer the asset to my wife. I will transfer my asset to your wife. So income you only take. My property's income I will take. Your property's income you take. But on papers it should look like they are only earning income, so that they can claim rebate. If that kind of a cross transfer transaction happens, then also it will get taxed. Let's see one example. Mr. X gifted 12 lakhs to brother's wife, Mrs. Y, and his brother Mr. Y gifted 8 lakhs to Mrs. X. Mr. X's wife gifted amount deposited in bank at the rate of 9%. So if the gifted amount transferred to, if the gifted amount is deposited in bank for interest, then the interest income is getting generated. No, that interest income will be clubbed in those transferors' hands. But here you one very very important point. Clubbing would apply only to the extent of cross transfer of gift. In above example, 8 lakhs is the cross transfer. See, Mr. X gifted 12 lakhs and Mr. Y gifted 8 lakhs. So how much is cross transfer happened? 8 lakhs only. Are you getting this? So Mr. X gifted to Mrs. Y and Mrs. X got a gift from Mr. Y. Whatever interest 48,000 is there no on 8 lakh rupees, that will get clubbed. Conversion of self-acquired property into property of HUF. Let's say for example, one of the members of HUF wants to convert the his own property into HUF's property. He want to get his individual name's property into HUF's name property. In that case also clubbing provisions will apply. Next, very very important point, boss. Income only we are discussing so far. Income, not only just income. Even if a loss, even if a loss is generated out of the transferred asset, even that will be clubbed in the hands of a transferor. Not just income. Even if a loss is generated out of the transferor asset, even that can be clubbed in the hands of transferor. Okay, thank you. Alright guys, let's start the next topic for marathon revision, which is set off and carry forward of losses. This is very chutku, very jujupi topic, very small topic, boss. We will start understanding this topic with the help of an example. Let's say for example, you are doing two kinds of business, boss. One business is garment business, business. The other is the hotel business. The other is a hotel business. So you are running two businesses simultaneously. For example, in garment business in this year, you earned profit of 10 lakhs, for example. 10 lakhs of profit you have earned. And under hotel business, you lost money. Means you have a loss of 2 lakh rupees. Now, if in the Income Tax Act, let's say for example, there is no provision for setting off this loss with the profit, then you will end up paying the tax on this 10 lakhs. No, let's imagine the tax rate is 10%. In that case, you will pay tax of 1 lakh rupees if there is no provision of a set off of loss, yes or no? But let's imagine there is a provision for loss set off. In that case, with this 10 lakhs, you will set off this 2 lakhs of loss. With the 10 lakhs of profit, if you set off this 2 lakhs of loss, then how much income you are supposed to pay tax on? Only 8 lakhs income you are required to pay tax on that 10% tax rate. Means you will be paying a tax of 80,000, yes or no? By setting off the loss with the profit, how much you have saved here? 20,000 of taxation you have saved, yes or no? This saving is given by the income tax department to all kind of taxpayers. So first what we have done, we have set off the loss. What we have learned in this thing, you can set off a loss with a profit income. There are a lot of conditions attached to it. We will look at it in some time. But what we have discussed just now is set off concept. Let's take one more example in which your loss is 10 lakhs from the business. Loss from the business is 10 lakhs. Income from one more business is only 2 lakhs. Income is 2 lakhs, loss is 10 lakhs. In this case, how much you can set off maximum this loss? Only maximum to the extent of 2 lakhs you can set off. The rest 8 lakhs you cannot set off with anything. No, then what you will do, you will carry forward that loss to the next year. You will carry forward that loss to the next year, and next year if there is income, you can set off the loss with that year's income. Are you getting that? So what we have learned now, there are two concepts. One is set off and the other is carry forward. Set off means setting off a loss with the profit, which is called set off. Carry forward means if due to less income you are not able to set off the total loss, then you can carry forward the loss to the next year, which is called as carry forward. So set off and carry forward we have learned. Now in setting off, in this whole set off and carry forward of losses, there are actually two ways you can set off and carry forward the loss. Number one, the first adjustment is called intersource adjustment. or it is also called as intra-head adjustment. It is also called as intra-head adjustment. And there is one more adjustment or one more set of which is called as inter-head adjustment. Inter-head adjustment of losses. So for setting of the losses, there are two methods or two ways, two alternatives are there. Number one, inter-source adjustment. Number two, it is inter-head adjustment. Inter-source is also called as intra-head adjustment. Let's first discuss about this thing in a detailed manner. Then we will go to this thing. Okay, wow. See, in inter-source, what is inter-source adjustment, sir? Inter-source or intra-head adjustment, what it is called. Simple, boss. Inter-source or intra-head means we have five heads of income: salary head, PGBP, capital gains, income from house property, and income from other sources. If intra-head or inter-source or intra-head is very simple, it means that if, let's say, for example, you have a PGBP head, yes or no, under that PGBP head, let's say you have two sources of income. The first example which we saw, you have a textile business, you have a hotel business. Both are falling under the same head, no, which is the head PGBP head. So if one head, if one source of income, if one source of income there is a income, and in another source if you have loss, these two you can set off. That is called as inter-source or intra-head adjustment. I repeat, under the same head, if you have different or multiple sources of income, in that case, if you are setting off one source income with the other source loss, that is called as a inter-source or intra-head adjustment. Are you getting this? Now let's take each head and let's try to understand where the set off of loss is possible. Whatever I am discussing now is only from the standpoint of inter-source adjustment or intra-head adjustment only. I am not discussing here the inter-head adjustments. Are you getting this? Now first thing is salary head. So out of the five heads of income we have, the first head we have is salary head of income. Is it possible to have a loss under salary? Not possible. So there is no scope for discussing anything on the intra-source, inter-head and all. Okay, wow. Next, the second source of the head of income is income from house property. Let's say, for example, you have two houses, house 1 and house 2. If house 1 has a income from house property and the other house, second house, has a loss from house property, in that case you can set off and carry forward the losses. So if the possibility of setting off a income with the loss is happening within the same head, that is called inter-source or inter-head adjustment. So under income from house property, you can set off one house's income with the other house's loss. Are you getting this? The next third head of income we have is PGBP. Let's say, for example, you have two businesses, business 1 and business 2. If one business is having income, the other business is having loss, in that case you can set off that income of one business with the other business's loss. But there are conditions here. If you are into speculation business, or if you are having 35AD specified business. I repeat, if you are having speculation business or if you having 35AD business, and if there is a loss under these two businesses, if you have a speculation business loss or a 35AD loss, 35AD specified business loss, in that case you have to be very careful. This speculation loss, special speculation business loss, will be only set off with speculation business income. You cannot set off with the other business incomes. Are you getting this? Speculation business loss will only set off with speculation business income. Likewise, specified business 35AD business loss will only set off with specified business income. Even though you will, let's say for example, you have a hotel business, or let's say for example, let me not take hotel, let me take textile business. You have speculation business, also you have specified business 35AD business you have. For example, this textile business is a normal business. Speculation business, let's say for example, you have a loss, and here let's say there is a profit, and here also there, let's say for example, loss. Here let's say for example the loss is 10 lakh rupees, here the loss is 1 lakh rupee, and here the loss is 80,000 rupees. Let's say, for example, you don't have any other business apart from this, then even though here 10 lakhs profit is there, you cannot set off these two losses with this 10 lakhs of business income, because that is what the loss is. If you are into specified business or a speculative business, that respective income only can be set off. Means speculation business loss can only be set off with speculation business income. You cannot even set off with the specified business income. Specified income, specified business loss can only be set off with specified business income only. I hope that is clear. The next head is capital gain. Very, very important, boss. See what kind of capital gains we have: long term capital gain, long term capital loss, short term capital gain, short term capital loss. Yes or no? Always keep in mind one thing: short term capital loss can be set off either with long term capital gain or a short term capital gain, but long term capital loss only it will set off with the long term capital gain. Very logical, you just think this is long term capital gain, long term capital loss, this is short term capital loss. Let me write here: long term capital loss, short term capital loss. For example, this is long term capital gain and this is short term capital gain. For example, now see, this short term capital loss, you can fit in this short term capital gain, you can fit no that box into box. Yes or no? It is possible. But can you fit this long term capital loss into this small short term capital gain? Not possible. But this short term capital loss you can fit in this long term capital gain. Are you getting this? Like this, you can remember: long term capital loss will only fit or set off with long term capital gain, but short term capital loss you can set off either with long term capital gain or short term capital gain. Is it clear? Next, whatever we are discussing, only inter source or intra head, within the head adjustment we are discussing. The next one is, last one is the income from other source. See, in income from other source, generally set off is possible, but there is only one special income, which is income from owning and maintaining race horses. Owning and maintaining race horses. Owning and maintaining race horses. If you are into this business and if there is any loss, that loss will only be set off with income from owning and maintaining race horses. You cannot set off with any other source of income. Are you getting that? Now, one more thing. There is one more income from other source, which is winnings, card games, and puzzle games like this. If you win any kind of or if you lose money in this kind of puzzle games or card games, in that case that loss has to be as it is ignored. You cannot do anything with that loss. So what we discussed: salary, there is no possibility of loss. House property, if you have a house property, one house property has a loss, the other has a profit, you can set off. In the case of a pgbp, generally with one business, you can, the other business can set off income and loss. But in case of speculation business, only you can set off loss of a speculation business can only be set off with the profit of speculation business, and loss from specified business can only be set off with income of a specified business. And in the case of capital gain, long term capital loss will not set off with the short term capital gain. Long term capital loss will only set off with long term capital gain, and short term capital loss can either set off with long term capital gain or short term capital gain. Income from other sources, you will keep in mind that card games, puzzle games, you have to ignore the losses. There is no possibility of a set off. Even with the other online game or card game or puzzle game, you cannot set off. Even with the same nature of income also, you cannot set off that loss. But owning and maintaining racehorses, if you're doing, in that case, income of loss of owning and maintaining racehorse, you can only set off with income from owning and maintaining racehorses. So whatever we discussed, it is from the standpoint of inter source or intra head, means within the head, how you can adjust the or set off the losses. Okay, now what we are going to discuss is interhead adjustment. Interhead adjustment means income from house property, you have income, business you have loss, then a business loss you can set off with the income from house property income, that kind of a thing. Now same we will go by head. Salary, can you have salary loss? Not possible, number one. Number two, income from house property. See, if you have a loss from income from house property, if you have a loss from house property, then maximum 2 lakhs you can set off with other head. Maximum 2 lakhs you can set off with other head. Maximum 2 lakhs you can set off with other head. But that too only under optional tax regime you can do this. But if you have a loss from house property and if you are paying tax under default tax regime, even that adjustment is not possible. Next, third, capital gain. See, capital gain losses, whatever are there, it only set off in intra-head only. Intra-head adjustment only you can do. Means inter-head adjustment in a long-term capital losses or short-term capital losses, it is not possible. Interhead adjustment for long-term capital losses or short-term capital losses not possible. Whatever adjustment of set off you do only in the case of inter source adjustment, or only in the case of within the head you can adjust the losses, but capital losses you cannot set off with any other head. It is not possible. Next, number 4, PGBP loss. PGBP loss, the same story. PGBP loss, whatever PGBP loss you have, you cannot set off with salary. Set off with salary, it is not possible. Other heads you can set off. PGBP loss, I repeat, you cannot set off with the salary income. All other incomes you can set off with. But remember, speculation business loss can only set off with speculation business income. Specified business loss you can only set off with specified business income. That will continue as it is. Income from other sources you will do intra-head. Within the head you will do the adjustments. Others you can just leave it off. It is not possible to carry forward, but yes, inter-head adjustment you can do. Now one more thing, if there is a loss from owning and maintaining resources, it will be only set off with income from owning and maintaining resources. Is that clear? Is that clear? Now very very important point, we have first discussed the set off and then we saw what is carry forward of losses. Yes or no? Set off means in the first year when you incur the loss you will set off. When you carry forward, see boss, in the year in which you incur the loss for the first time, you can do inter head adjustments. Means, let's say for example PGBP in business income, if you have a loss, you set off this business income with, for example, income from house property. Loss from a business you set off with income from house property, but still there is some loss pending. That loss you will carry forward to the next year. Once you carry forward to the next year, in the next year you cannot set off with other heads. You have to set off with the same head of income. Are you getting this? So in the first year in which you will incur loss, inter head adjustment is possible, but once you carry forward to the next years, only within the head you have to set off that carry forwarded loss or brought forwarded loss. You cannot set off with other heads of income. Let's look into the material now and let's understand in a slow manner. Set off means adjustments of loss against the profits from another source or head of income. Carry forward means if losses cannot be set off in the same year due to inadequacy of profit, then such losses are carried forward to the next year. What is the inter-source or intra-head adjustment? Loss incurred in respect of one source can be set off against income from any other source. Inter-head adjustment, loss under one head of income can be adjusted or set off against income under another head. Impermissible inter-source or intra-head adjustment means those adjustments which are not permissible under intra-head or inter-source, means within the same head, which are those set-offs which are not possible. Long-term capital loss. As I already told you, long-term capital loss cannot be set off with the short-term capital gain. LTCL can be set off only against LTCG. LTCL cannot be set off against STCG. STCL can be set off against both LTCG and STCG. We have already discussed just before few minutes in detail this thing. Speculation business loss, I told you it can be only set off with the speculation business income. Loss from activity of owning and maintaining resources, you can only set off with the maintaining profit from maintaining and owning racehorses. Specified business 35 AD. Here very very important point. See, 35 AD deduction itself is not available under default tax regime. So if you are opting under optional tax regime, then only you can set off that loss. Under a default tax regime, there is no option for 35AD only. Then where is the name of a loss coming in here? Are you getting this? Next, interhead adjustment. Loss under any head other than capital gains, because I told you capital losses don't set off with any other head. Yes or no? Only intra-head adjustment happens in a capital losses. Loss under any head except capital loss can be set off against any income under any head, but there are few exceptions. Loss under the head PGBP, I told you it cannot be set off with salary income, cannot be set off against salary income, can be set off against income under any other head including capital gains. So loss under PGBP I can set off with capital gains, but capital losses will not go and set off with other heads. Loss under the head capital gains, both short term and long term capital loss cannot be set off against any other head of income. Loss under income from house property. I told you already, up to 2 lakhs, it is available only in the case of optional tax regime. In default tax regime, loss of house loss of house property you cannot set off with any other head of income. Optional tax regime can set off with any other head of income. Maximum set off available is 2 lakhs, but under default tax regime you cannot set off income from house property loss with any other head of income. Speculation business loss, I told you it can be only set off with the speculation business income. 35AD also it is possible. Now once you carry forward, for how many years I can carry forward, sir? Very simple, boss. House property losses you can carry forward for next 8 assessment years. PGBP incomes you can carry forward for next 8 years. Speculation business loss you can carry forward for next 4 assessment years. 35AD business loss you can carry forward for unlimited years. Short term capital loss you can carry forward for next 8 assessment years. Long term capital loss you can carry forward for next 8 assessment years. Income from other sources, in which loss from owning and maintaining resources you can carry forward for next 4 assessment years. Are you getting that? In if you have any other income from other sources loss, carry forward is not allowed. Only in the year in which you incur loss you can make interhead or intrahead adjustment, then carry forward it is not possible. There are some important points. See, if you want to carry forward the losses, it is mandatory to file the return within the due date given under section 139(1). But there are two exceptions. Means in two cases, even if you filed the tax return late, still you can carry forward the losses, which is in the case of house property and unabsorbed depreciation. Unabsorbed depreciation you can carry forward to unlimited years. Now, once you, let's say for example, there was a business with you and it had accumulated losses, which is yet to be set off with the incomes, and you sold this business to someone, then the successor of business cannot set off those the losses which you transferred to the other person. But there is one exception. If by inheritance someone has got the business in his hands, then if already some accumulated losses are there, those losses can be set off in this hands of the successor. Business loss can be carried forward set off only by the same person. Successor of business cannot set off brought forward losses of his predecessor except in the case of inheritance. Inheritance means father has given a business to son, that is called inheritance. Loss from lottery, card games, races, you cannot set off this loss. Even with the same income also you cannot set off, and with other heads also you cannot set off. You have to just ignore them. Any loss cannot be set off against income under section 115BB. Horse races cross means you cannot set off any loss with the income of these special games, crossword puzzles, income from TV shows, etc. Loss from horse race, crossword puzzle, TV shows, other games shall be totally ignored. The same dialogue. Brought forward business loss can set off even if business is discontinued. Means even if you have discontinued the business, still you can claim that loss. Loss from specified business can be set off only with specified business income, even though the latter is not available. Means let's say for example, brought forward loss from eligible hospital with minimum 100 beds can be set off with ineligible 2-star and above hotel business profits. So specified business loss can be set off with even non specified only, but ineligible specified business, still you can set off that loss. If there is any unexplained income investment, you remember that black money which we discussed in the basic concepts chapter, then in that case set off of loss is not possible. Sir, what is the order of set off, sir? See, very simple. First, current year depreciation you will claim against current year income. Then second, you can claim the, or you can set off the brought forward losses from a business or profession. Finally, you will take a unabsorbed depreciation. This is in the case of a PGBP, you will do like this. I hope this is clear. Thank you so much. Hi guys, let's start the last topic of our marathon revision, which is return of income and self-assessment. First of all, what is self-assessment? Self-assessment means whatever you have learnt in this whole marathon, that whole process you will apply for your own self. Means you will have to compute your own total income, your own tax liability, everything you will compute, and then you will fill all the details in a form which is called as return of income. Return of income. So the form which you file with the income tax department, the form through which you pay the tax is called return of income. Otherwise also it is called as income tax return. Are you getting this? So self assessment is the process through which, is the procedure through which you arrive at your total income and tax liability. Once you know all your total income and tax liability, you fill all the details in your income tax return and file it with the income tax department. But who all are required to file the income tax return, sir? Is it that every person in this India, in this country, has to file the income tax return? It is not like that. But keep in mind one thing: who is asking you to file return of income? Mandatory filing of return of income under section 139(1). Company and firm, including LLP, are mandatorily required to file the return of income, irrespective of their income boss. They have a loss or income, nothing does not matter. For a company, LLP, and a partnership firm, it is mandatory to file a return of income. In all other assessees case, if the income does not exceed basic exemption limit, then they are not required to file a tax return. Companies, firms, LLPs are mandatorily required to file return of income. Assessee other than a company and firm shall file return of income only if the total income before deduction under chapter 6A and before exemptions exceeds the basic exemption limit. So when I told basic exemption limit, it means that before you claiming chapter 6A deductions and before claiming exemptions under section 54, that capital gain exemptions, before claiming those deductions and exemptions, if your total income is less than basic exemption limit, you are not required to file return of income. But if your total income is exceeding basic exemption limit, then you are mandatorily required to file return of income. There are some special other cases in which a person is required to file return of income irrespective of his total income. Every resident person shall file a return of income if that resident person holds any asset outside India, or has any financial interest outside India, or has any signing authority in any account outside India, or is a beneficiary of any asset outside India. So if you have any connections outside India financially, then you are required to mandatorily file a return of income. Person other than a company or firm not covered in above points required to file a return of income. Means if you are a person other than a company or a firm, then there are some special cases in which you are mandatorily required to file return of income. Which are the special cases? If you deposited in a current account exceeding 1 crore rupees in a financial year in a bank, then you are required to file return of income. If you deposited more than 50 lakhs in a financial year in a savings account, then also you are required. If you go for a foreign trip and if you have spent more than 2 lakh rupees, you are required to file return of income. If your electricity expenditure is more than 1 lakh rupees, then you are required to file a income tax return. And if you are doing business and if your turnover exceeds 60 lakhs, and if you are doing some profession and if your gross receipts exceeds 10 lakh rupees, in that case you are mandatorily required to file tax return. If aggregate TDS and TCS on your name deducted more than 25,000 on your name, then in that case you are required to file return of income. The limit will become 50,000 if you are a senior citizen. Now, sir, when should I file a tax return, sir? See, if your business has a TP audit, means a transfer pricing audit, in that case the due date is 30th November of assessment year. If not a transfer pricing audit, but you have a tax audit under section 44AB, in that case the due date given is 31st of October, and in all other persons it is 31st July. Sir, please explain with one example. Let's say, for example, for the previous year 2022-23, you will first compute your tax, income tax liability and total income. Then you have to file a return of income within 31st of July 2023. So the due dates, the dates whatever are given here, are in the assessment year. So 31st of July of assessment year. For this previous year 22-23, the assessment year is 23-24. No, of that 23-24 assessment year, 31st July will fall. Are you getting this? Next, there is a return called as a loss return. Means you would have read in a set off and carry forward of losses concept that there are few losses you cannot carry forward if you are a if you have not filed the return of income within the due date mentioned under section 139(1). That is a loss return. The return which has a loss, that return is called a loss return. You cannot carry forward losses if you have not filed the return within the due date mentioned under section 139(1). For carry forward of losses, mandatory to file return of income. What are the losses, sir? Business loss under 72(1), speculation loss, specified business 35(a)(d) loss, and any other capital gain losses also. Capital losses if you have long term or short term, and losses from owning and maintaining resources. If you have any kind of these losses and if you want to carry forward them, you have to mandatorily file the return of income within the due date. Belated return means, let's say for example, you forgot to file the return of income, or for some reason you could not file the return of income within the due date mentioned under section 139(1). In that case, you can file a belated return. Belated return can be filed, but till what time I can pay, sir? Can I file the belated return, sir? Let's say for example, for 2022-23, the assessment year is 2023-24. Yes or no? Means the assessment year will end on what? Will actually end on 31st of March 24. March 24. Yes or no? But for this previous year, let's say for example, your 31st July 2023 is the due date to file a 139(1) return, but you forgot to file the return. In that case, maximum by 31st of December 2023, before this date you have to file the return of income. The belated return should be filed before 31st of December. Means for previous year 22-23, you can maximum file the belated return within 31st of December 2023. So here it is given, due to some reason if the return of income was not filed within the due date, then before 3 months prior to end of. So the language is bit confusing, but actually technically speaking, 31st December of assessment year, whatever is date is there, no, before that you can file your belated return. The same due date applies even in case of a revised return. What is a revised return, sir? What is a revised return, sir? That is filed under section 139(5). Revised return means you already filed a return, but by some mistake you filed some wrong information in the original return. Then you can revise the return, but the due date also here for revision is the 31st of December of assessment year. Are you getting that? Are you getting that? So how many times I can revise the return? You can revise the return any number of time, boss. 1 time, 2 time, 3 time, 10 time, but before 31st December 2000, before 31st of December of the assessment year itself, you can revise the return. Defective return means you by mistake, see, actually income tax return, there is no one there is no only one form. For depending on the nature of income or depending on the person who is filing return of income, there are different forms: ITR 1, ITR 2, ITR 3, ITR 4, like this. By mistake you chose a wrong ITR form and filed the return, that is called a defective return. By, let's say for example, you paid tax but you did not attach the tax proof. In that case also you can file a that return is also called as defective return. The return of income filed by SSC processed by software, due to following reason, it can call it as a defective. Wrong form, proof of tax not attached, or you forgot to attach the tax audit report. In that case also it will be treated as a defective return. Now there is updated return concept, boss. Means, let's say for example, for previous years, you did not file the return of income and the due date of belated return is also gone by. I repeat, for one of the previous years you did not file any return of income and the due date of belated return also went off. So now you do not have any option to file return of income. No, that is why this concept of updated return has come. So if you want to file return of some previous years, in that case you can file, but there is only one condition: you cannot claim losses under this updated return. If you want, you can offer more income, or if you want, you can pay more taxes, but you cannot take more refund, or you cannot claim losses on this. under this thing. From 1/4/2022, this concept is applicable. You can file updated return for paying taxes. You can file a updated return for paying taxes on means for clubbing income also. Are you getting this? You can file updated return even if return of income under section 139(1)(4)(5) is filed or not filed earlier. So if you, even if you have filed earlier a return, even then you can file this updated return. It is kind of a revision only, no, but you have to offer more income to tax. But even if you have not filed return of income earlier, still you can file updated return. Both cases you can file updated return. Updated return cannot be filed in below cases. Updated return cannot file if you have a loss return or results in a decreasing in tax liability or increasing in a refund. Now there is a due date. The updated return shall be submitted within 24 months from the end of a relevant assessment year. Means, let's say for example, for AY 25-26, for AY 25-26 means for previous year 24-25, maximum within 31st of March 2028 updated return can be filed. Next, whenever you file updated return, if you offer the extra income to tax, no, for that additional tax has to be paid. How much, sir? If updated return is furnished after expiry of time under 139(4) or 5, means after expiry of a belated return under revised return due dates, but before 12 months from the end of relevant assessment year, if you have filed. So if you have filed the updated return before end of 12 months of a relevant assessment year, in that case 25% of whatever tax liability and interest is there, no, on that 25% extra you have to pay tax. But if you filed updated return before 20 months, means after 12 months but before 24 months from the end of relevant assessment year, in that case you will pay excess of extra tax of additional tax of 50% on the normal tax. Is it clear? Next, there are some pan linking provisions, totally theoretical, just you can have a look and leave it. So that's wrap our total marathon, boss. Thank you so much.